We dismiss history at our peril.
Liberty Nation Radio with Mark Angelides.
Just how much more shock can the American economy withstand before folks decide to just call it a day? As a prominent Californian bank shutters its doors, the White House scrambles to avoid a wider market contagion. But does the president instill confidence? Well, that's the $25 billion question. Welcome to Liberty Nation Radio here on the Radio American Network. I'm your host, Mark Angelides. On today's show, we talk the potential dangers of a banking collapse, the solutions on offer, and take a look at the latest gun control laws coming down the pipeline. I'd like to take a moment to wish a fond hello to our listeners out in Chester Springs, Philadelphia on WFYL 1180 AM. Thanks for being here. Remember, this show is proudly sponsored by LibertyNation.com, where you can access podcasts, breaking news, analysis, and a range of biting and brilliant shows to whet your appetite for freedom and your fondness for the great American Constitution. With the collapse of Silicon Valley Bank, tongues are a-wagging about whether this was merely a first domino in a crisis set to consume the industry, or just a blip in the economic dystopia America is facing. Now, the best reporting on this topic is on the pages of LibertyNation.com, written by Liberty Nation's economics editor and host of the excellent Swamponomics show, which I recommend you all tune into, Mr. Andrew Moran, who joins us here today. Thanks for being on, Andrew.
Thank you, Mark. And I will say that all the deposits are in Mark's house and Laura's house. That's my James.
Thanks very much. It's a wonderful life. Now, Andrew, let's get the basics down on this first. Sure. What caused Silicon Valley Bank, SVB, to fold?
Well, she can write a whole thesis on what transpires. I'll try to summarize it best. So the first thing is that when Silicon Valley Bank started, it had these exorbitant amount of deposit rate to attract, tech startups, tech executives, a lot of that Silicon Valley community. In order to offer those exorbitant rates, which are so much higher than a lot of the other larger banks offered, they bought long-term bonds to offset that risk. The problem with them when they started buying these long-term bonds is that when the Fed started raising interest rates, the value of those bonds started crashing. So if you look at LibertyNation.com, we reported on, which a lot of people did, Liberty Nation reported on the collapse of the bond market. So their balance sheet were completely decimated by this. And the other issue with Silicon Valley Bank is that they lended a lot of money to some of their depositors who are really risky venture capitalists, venture firms. So when you have those two issues mixed with a collapsing bond market, which completely erased their valuations, that's when you had that problem with Silicon Valley Bank collapsing.
So you wrote an article recently, one of many on this topic, describing how this particular bank was marked as a safe bet by auditors. And where's the responsibility here, Andrew? Why can these audit outfits get away with, like, literally a few weeks hindsight be considered sloppy analysis?
Well, the organization that was in charge of the auditing firm, they said that they monitored the 2022 books for SVB. They said that they didn't see any problems, and that anything happened after that period, it wasn't their responsibility. But my contention is that couldn't you? Because the whole point of audit is to identify potential risks at a financial institution. This thing didn't spring up overnight. It didn't happen after Greg Brecker sold $3 million of his shares. This thing started going on probably last spring when the Fed started raising interest rates. So that was sloppy reporting. Now, I will defend the company that did the audit. They also gave high marks to Signature Bank. Now, Signature Bank didn't see any. According to the board of directors anyway, they didn't see any financial problems. The problem with
Signature Bank was the second bank that had issues in these last weeks.
Yeah, well, actually, it was a third bank. The other one was Silvergate. But Signature Bank, according to board of directors, one of them was Barney Frank, who was a congressman. He was the chief of the Dodd-Frank bill. He said that their books were fine. The problem is that it was a contagion event where depositors were spooked by what happened to Silicon Valley Bank, and then they withdrew $10 billion in one day. And that's when the federal regulators saw a problem, and then they shut it down, and they sent a message saying, you got to be careful with these issues. You got to have greater capital. So that's what happened with
that really brings up a question that I think has been completely ignored. Maybe not a question as such, but more a position. You say that depositors took out tens of billions of dollars, and yet $10 billion. When that is 1/10 of billions. Learn set theory. So you have You have Joe Biden, and we'll talk about the solutions that are being proposed later in the show.
Sure.
But you had Joe Biden give a speech about how, you've got your basically your mom and pop businesses that will be able to pay their workers and keep their lights on. That's not Silicon Bank, Silicon Valley Bank depositors by and large, is it? Is it
No.
90% of its depositors are looking for investment vehicles? They're not people, let's use this high street bank or retail banks, I guess we call them in my country, to just manage their current account or their checking account. These are people looking to make money with things. This is not, as Joe Biden intimated, just regular working folk dealing with their daily banking.
Yeah, exactly. And that's the thing with Silicon Valley Bank is that 90% of the depositors had amounts that exceeded the deposit insurance limit of two hundred fifty
Quarter of a
thousand dollars.
million
So these weren't
dollars.
just
Quarter of a million. Yeah.
yeah, $250,000 the limit, which is the deposit insurance. That's how much you're insured for. So 9%. So if 9% of their clients have exceed that amount, it's safe to say that it's not just your 80-year-old grandmother sitting there on her pension fund. It's not the case. These are wealthy people. These are well connected, and I agree with a lot of Republicans who say that it's just Joe Biden and the federal government bailing out their buddies in Silicon Valley who lean heavily left. So yeah, I agree with that supposition.
So let's dig into this. And so we had the analysis, the audit analysis, and it failed to recognize things that you say, or well, the data, I guess, suggests that these things were happening last spring. But is this a one-off? Do we think is this one blip in an otherwise stable banking industry, or is there a deeper trend that with that? Let's not go to what's the word, Chicken Little on this thing, but is it a deeper trend that people should be watching? Perhaps audits being too optimistic, that kind of stuff.
Well, it depends on a wide variety of factors. I'm sure right now a lot of analysts are combing through the balance sheet of a lot of these banks. So one of the big issues with a lot of these banks, whether it's the regional banks or the major banks like Wells Fargo or Charles Schwab, is their list of unrealized losses. So if these unrealized losses are continuing to expand on their balance sheet, you're going to have issues with that financial institution, no doubt about it. On the other hand, if these major banks come into trouble, as we've seen with SVB and Signature, the Federal Reserve and the federal government are going to inevitably intervene. That's what they're doing right now. I mean, the Federal Reserve, so part of their plan is extending loans of up to 1 year to banks that were, or saving institutions or credit unions that were impacted by SVB. Now, they're going to extend this to pretty much everybody right now. They have that the 1 year facility, and then you have the Federal Deposit Insurance Corporation offering bailouts to people who are uninsured bailouts to depositors, and then you have the Treasury Department offering up to $25 billion as a backstop. But it's not going to stop there. If you do have a contagion effect, a domino effect of these banks, it's going to be QE infinity. And consider this for a moment. The FDIC has about $125 billion in reserves. SVB had $150 billion in uninsured deposits. Where's that extra money going to come from? It's not going to come from, these wealthy depositors. It's going to come from, guess what? The Federal Reserve unleashing QE infinity and having unlimited deposit insurance. It's not going to be the $250,000 limit anymore. It's going to be probably, as some have suggested, $600,000, and as some have even suggested, having guaranteed all bank deposits, which of course is a can of worms that's going to lead to inflationary mess and
Now,
moral hazard, if I may say.
there is another aspect to this, and that is that Silicon Valley Bank had its issues because it's Silicon Valley Bank. And if we look at, I mean, this is a bank, a banking vehicle that is set up to cater to tech companies, startups, places around the area who deal with Silicon Valley.
Mm-hmm.
And what we've seen over the last, I guess, year and a half is companies like Meta, or Facebook, I guess we know it best as, laying off tens of thousands of workers, losing Mark Zuckerberg losing billions of dollars. Now, is it specific to the industry, do you think, that caused for example, the unrealized gains unrealized losses that you talked about to sort of come to fruition?
Yes, I've spoken to some economists over the recent days, and some of them have made the case that these are just specialized instances whereby, in the SVB's case, it had direct ties to the tech industry, which has been slaughtered since the Federal Reserve raised interest rates, and then you can make the case that this whole thing started because of that period of extremely loose monetary policy. That's perhaps another conversation for another day. Silvergate, it crashed because of the crash in the crypto markets. It was completely entirely focused on crypto. And even Signature Bank also was a crypto lender, so it had direct ties also to Bitcoin, Ethereum, and that market has been slaughtered too. So I could see the case whereby they say, okay, yeah, these are just isolated incidents. Maybe there's not going to be a large liquidity issue, but perhaps it leads to a broader conversation. The problem you have is that this ties into the Federal Reserve's M2 money supply, which has actually contracted 2 straight months for the first time on record. So it's such a coincidence whereby you have a liquidity evaporating from the system, and then you have these banks having financial troubles. So I think that's an interesting tie-in.
As James Bond author Ian Fleming wrote, once is happenstance, twice is coincidence, third time is enemy action. Now, we're talking with Andrew Moran on the SVB collapse and what it means for America and the wider industry. And we'll be back with Andrew after this short break to continue the analysis. Don't go anywhere. We dismiss history at our peril.
Liberty Nation Radio with Mark Angelides. Entertaining, informative, and just plain fun. Watch Liberty Nation's The Conservative 5. Produced by conservatives for conservatives. C5's The Left Free Zone. Hosted by Liberty Nation's Lisa K. Donner. Joined by a raucous, irreverent panel of authors. Deconstructing leftist narratives. Debating the hot topics. And remembering to laugh. Join the official conservative safe
You only
space.
did that to piss Jeff off.
Liberty Nation's The Conservative 5.